Welcome to Personal Finance for Long-Term Investors, where we believe Benjamin Franklin's advice that an investment in knowledge pays the best interest, both in finances and in your life. Every episode teaches you personal finance and long-term investing in simple terms. Now, here's your host, Jesse Kramer.
Hello and welcome to episode 107 of Personal Finance for Long-Term Investors. My name is Jesse Kramer. Later in today's episode, Don McDonald is going to join us. Don is a longtime financial radio host of a show called Talking Real Money. He's an author, an educator known for his no-nonsense approach to investing in personal finance. I feel a bit of a kindred spirit to Don because Don and his business partner, they use their radio show to springboard into providing fee-only, evidence-based fiduciary financial planning work. And although my path is a little different, I've ended up in a similar spot using my blog and this podcast to end up working at a fee-only, evidence-based fiduciary financial planning firm here in Rochester, New York. Now, Don hates annuities. I feel pretty similarly, and that's a lot of what we talk about today. But before Don, let's do a review of the week. The doctor's orders wrote in and said, "The right prescription. I'm a semi-retired, almost 70-year-old physician who listens to a lot of retirement, investment, and economics podcasts. I actually don't recall how I stumbled on your podcast a few months ago. However, you are amongst the top few in terms of clear and efficient communication, giving both broad concepts and applicable practical points. You are able to distill complicated topics without making it unrealistically simple. Keep up the good work." Well, thank you, the doctor's orders. I appreciate the kind words and the 5-star review. Feel free to shoot me an email to jesse@bestinterest.blog, and we will get you a really nice, super soft Best Interest t-shirt. But before we get to Don McDonald today, since we're talking about annuities and insurance salespeople who call themselves financial advisors, really what we're talking about is this spectrum of good advisors and bad advisors and the messy spaghetti ball of different types of advisors out there. And so in honor of that conversation, I want to do something fun. I want to go through an article from the Wall Street Journal that I absolutely love. It's called "The 19 Questions to Ask Your Financial Advisor. The Burden of Finding an Advisor Who Will Act in Your Best Interest is on You." It's written by Jason Zweig, perhaps the best modern financial journalist, simply respected as among the best. And the reason I'm reading this particular article and not a different list that maybe I put my finger on is because I want to share a neutral outside expert's opinion on these questions, not my own opinion. And I'm sure my own opinion has some bias to it, so I want to go through Jason's list as he wrote it. At the end, though, I do think there are a couple extra, non-controversial questions that I believe also makes sense for you to ask to add onto this list. So I'll sprinkle those in at the end without too much extra comment, and then you can make up your own mind if you think it's worth it. And if you want a copy of this article for your own records, please shoot me an email to jesse@bestinterest.blog, and I will email a PDF to you. So for the article, I'm going to skip the intro to the article, and I'm going to go straight to the list, to the 19 questions, because I think that's the place where most readers go to, and that's really just what I want to share with you today. The way that Jason Zweig wrote this article is he poses the question that you ought to ask your financial advisor, or any financial advisor who you might be interviewing, and then Jason proposes his ideal answer, the way that the advisor should be answering this question. And I'll give that to you as well. And then in some cases, I'll mention why I agree, why I disagree, and just why potential advisors' answers might be different. Again, just to add some color to your understanding. So the first question, are you always a fiduciary, and will you state that in writing? Jason Zweig says the answer should be yes. I also say the answer should be yes. I do want to caveat that, though, with something I brought up in episode 90, an AMA episode, that unfortunately, the fiduciary filter alone isn't as good as it used to be. It's still very important, but what I mean by that is some people will tell you that they are a fiduciary, and the reason why is because they probably have an ethical fiduciary obligation. That's different than a legal fiduciary obligation. It's too bad that there's that confusion out there. But essentially, if someone has a legal fiduciary obligation, it means that if they don't act in your best interest, you ought to take them to court. That's the level of fiduciary obligation that I have. It's legal. If someone only has an ethical fiduciary obligation, well, then we get into a bit of a gray area, because now there's almost a little bit of he said, she said, where they could defend themselves in saying, I believe I was acting in your best interest, even if maybe they weren't. So again, that's where I think the legal fiduciary obligation really is the important one there. The second question, does anybody else ever pay you to advise me? And if so, do you earn more to recommend certain products or services? The answer there should be no. Totally agree, right? All else equal, someone who's earning a commission to sell you a particular insurance product or to make certain trades in your portfolio, That's a conflict of interest with what's in your best interest. And so we don't want commissions, all else being equal. The third question, do you participate in any sales contests or award programs creating incentives to favor particular vendors? The answer there should be no. And I agree with that. All else being equal, right? The investment advice that an advisor provides to you should be conflict-free. It should be what's in your best interests. And if they're participating in a sales contest or an award program, if they're getting an incentive to favor a particular vendor, well, all of a sudden that's not in your best interest anymore. The fourth question, will you itemize all your fees and expenses in writing? The answer there should be yes. I agree. The answer there should be yes. A fee schedule should be really simple, right? Fees should be really simple to understand. It should be a certain percentage, an hourly rate, a number per year or a number per month. Very straightforward, very straightforward. Number 5, are your fees negotiable? Jason Zweig says the answer should be yes. I actually have mixed feelings on this one. The reason why, I've been now doing this for 3.5 years, and sure, plenty of people have asked me if they can negotiate our fees. The problem that we run into, though, is if I have 2 different clients, right? The Smiths and the Joneses. And if the Smiths are paying our normal fee, but then the Joneses have negotiated down to say 20% off our normal fee. Now, in my head, it's like, do I have an incentive to serve one of them more than the other because one is actually paying us more? I don't want to enter that brain space if I can help it. And then the second problem, or the other side of that same coin, is if I am serving them totally equally, is that really fair to both clients? Or really, I kind of forget my example, which one's paying more. But let's say the Smiths are paying more. Is it fair to the Smiths that I'm giving the Joneses the same exact level of service, the same exact benefits? I'm providing everything the same to them, except they're paying 20% less. Those are some of the maybe ethical conundrums that we face with fee negotiations. And that's why, all else being equal, we try extremely hard to not negotiate fees. We don't want to negotiate fees. If there ever is a time when someone is leaning on us hard, maybe we'll consider giving someone a break for a quarter or two to get their foot in the door. But then we quickly say, hey, we know what we're worth. We know the value we bring, and we are going to make you return to our standard fee schedule going forward. So there's one where I break with Zweig. I'm interested to hear any of your listeners' thoughts out there. The 6th question, will you consider charging by the hour or retainer instead of an annual fee based on my assets? Jason Zweig says the answer should be yes. And I think it's so important that there are different fee models out there for different types of investors. At one time, my firm, Cobblestone, we offered hourly consultations. Ultimately, though, as a business, we were finding more success and more clients via our annual fee schedule. And as a business, I think sometimes you have to come to a crossroads, right? Do you spread yourself thin over different services, or do you double down on what's working well? And we, as a business, we doubled down on what's working well. We're glad we did. And so now our fee model is an annual fee. We don't do hourly consultations anymore. But some people, including some of you listening, maybe all you want or maybe all you need is an hourly consultation. And I think it's great that there are some planners out there who have built that business to meet that demand. Number 7, can you tell me about your conflicts of interest, both orally and in writing? Zweig says the answer should be yes. He also says that no advisor should deny having any conflicts. And I totally agree. Every advisor out there has conflicts of interest, just like every barber or every landscaper out there has conflicts of interest. Every barber has a conflict because if they tell you that you need a haircut, well, that's their revenue. And every landscaper out there says, of course you should put in a sidewalk here because that's their revenue. Their revenue, to some extent, is your loss. It's what you're paying. And that is a natural conflict of interest. Therefore, it's really important to understand how someone gets paid. In general, from what I've seen, the AUM fee-only model, the retainer model, and the hourly model are the most beneficial for clients. Those advisors are incentivized to do good work over the long run on your behalf. You win together. They're incentivized to retain you as clients, to be fair to you as clients, and to make this a long-term win-win relationship. Now, the commission-based fee models that I've seen are generally not ideal since their incentives are not aligned with the typical long timelines of their clients. In general, those are more sales-oriented incentives where the main incentive is just to get you to say yes today, to make a sale. And even if the advice isn't always in the client's best interest, that is a conflict with what the advisor wants in those situations. So anyway, the answer there, just to get back to Zweig's question, every advisor has some level of conflict of interest. And the important thing is that both you as the client and your advisor, that you both know that and that you understand what that is. Number 8, do you earn fees as an advisor to a private fund or other investments that you may recommend to clients? The answer there should be no, and I agree. Number 9, do you pay referral fees to generate new clients? The answer there should be no, and I agree. That one, and I think there's another one, we'll get to it to number 11, and I'll skip ahead to number 11, and then I'll kind of tackle them all at once. Number 11 is, do you earn fees for referring clients to specialists like estate attorneys or insurance agents? No. So 9 and 11 to me are kind of two sides of the same coin, which is basically, if a local accountant refers a client to me, do I pay that accountant for that referral? Or similarly, if I'm going to refer a client out to an accountant to do their tax work, am I expecting that accountant to pay me for it? And the answer should be no in both directions, right? The whole fiduciary conflict of interest conversation is you need to avoid as many conflicts as you can. The one that naturally exists is the one that says, well, hey, you've got to pay me for the work I do. That's the natural conflict of interest. But outside of that, there really shouldn't be any conflicts of interest. And so, right, when it comes to referrals, I want an accountant to refer business to me because he thinks that I and my firm, Cobblestone, are simply a terrific fit for this particular client. And I want to refer clients out to a trust and estate attorney or an insurance agent or an accountant because I believe that specific other professional can provide the solution that my client needs at a fair price. That's it. So again, there should not be any referral fees in either direction, in my opinion, and Jason Zweig's opinion too, I should say. Number 10 on the list. So we did 9 and 11. Now we're going back to number 10. Do you focus solely on investment management, or do you also advise on taxes, estates, retirement and budgeting, debt management, and insurance? And Zweig says here, the best answer depends on your needs as a client. And I think that's fair. Every advisor probably has a slightly different focus, or just there is a spectrum of what different advisors do. Some will say all they do is investment management. Others will do no investment management at all. And all they do is planning work, like retirement planning or tax planning. Here, my colleagues and I, we provide what we believe is holistic, comprehensive wealth management. So it's inclusive of investment management, tax advice, estate planning, retirement planning, simple budgeting, debt management. We do things like we will help a client understand their insurance need. We don't sell insurance though, right? That would be a conflict. We will help a client do tax planning, but we don't file taxes because again, that's a conflict. We don't write legal documents because that's a conflict, but we advise on all this stuff and we have in-house experts when it comes to this stuff. We will come back to those in-house experts when it comes to question 17. But again, I think it's fair what Jason Zweig says is you as a client, you need to understand what your advisor's focus is. Are they investing only? Are they planning only? Do they do a whole bunch of stuff? And if they do a whole bunch of stuff, do they really have the expertise to do it? You should ask that question. But the best answer for you will depend on your needs as a client. We already did number 11, so let's go to number 12. What is your investment philosophy? And this is an interesting one because Zweig doesn't have a proposed best answer here. Again, I think that's fair because I've had clients come to me before and their personal investment philosophy is say they want no risk. All they ever want to do is hold bonds. So build me a bond portfolio. Now, I don't really think that's the best way to go about the investing problem, especially if someone is, say, younger. I've had other clients come to me and they say maybe, hey, what's Cobblestone's thoughts on crypto? Well, we don't invest in crypto. So if you want us to build you a crypto portfolio, sorry, we're not the right firm for you. I think our investment philosophy is very much in line with all the things I talk about here on the podcast, if you're curious. And that's one of the reasons why I feel good talking about the things I talk about here on the podcast. But yeah, it is important for you to ask your advisor what their investment philosophy is. And hopefully their investment philosophy matches up pretty well with your understanding of the world. Number 13, do you believe in technical analysis or market timing? The answer there should be no. I agree. Technical analysis, for those who don't know, is where an analyst will look at charts almost like reading the tea leaves and saying, because of the way that this particular stock or because of the way that this particular index has behaved over the last day or the last week or the last month, I can therefore predict how it will behave in the near-term future. Yeah, that's, to me, at least, that's been debunked. It seems to be a bit of an ongoing debate in the investing world, whether there's any merit to it or not. I personally don't see the merit to that. And it's related to market timing. Again, it's the whole idea of, do I believe I know enough to know when the market is about to move drastically in one direction or another? And will I make kind of ad hoc decisions based on that? The answer there should be no. Number 14 is a similar, but it is a nuanced and important different question. Do you believe you can beat the market? Zweig says the answer there should be no. And yeah, the short answer is no, but there is a longer answer that I think is worth covering here. because I've talked about it here on the podcast before, and I'm going to name two specific famous Nobel-winning academics, Eugene Fama and Ken French, huge proponents of index investing and, huge proponents of this idea that you can't stock pick or market time your way to beat the market. But they won their Nobel Prize for their work in what's called factor investing. And in short, they found that, at least so far in history, one can outperform the market average over a long period of time by tilting your portfolio towards certain factors. Now, what are these factors? Well, perhaps the most well-known factor is that value stocks tend to outperform growth stocks. Another famous one is that small companies tend to outperform large ones. Cheap companies outperform expensive ones. That's like on a price to earnings ratio basis. Profitable companies outperform the less profitable ones, and that's sometimes called a quality factor. And then conservative companies tend to outperform aggressive ones. Now, these factors, they haven't always been true all the time. They're not going to lead you to be filthy rich if you follow them. But the academic research shows that if you tilt your portfolio in these directions over time, they can lead to outperformance. Now, there's an entire nerdy, detailed podcast episode tied up in this topic. But the reason I mention it goes back to the idea of evidence-based investing. Now, Fama and French, like I said, they don't believe in stock picking, but they do believe in tilting a portfolio in favor of these evidence-based factors, and so do we, and so do I. Question number 15, how often do you trade? Zweig says the answer should be as seldom as possible, ideally once or twice a year at most. Yeah, in large part, I agree with that. I'm assuming rebalancing a portfolio is different than trading in this case. I think trading to Zweig means, how often do you make a decision about, should you be 68% US and 32% international? Should you go slightly underweight, slightly overweight? I assume that's what he means there. Rebalancing, I think, can occur more often than once or twice a year. Quarterly is fine. If you have a rules-based system where you say if a portfolio gets more than 3% or more than 5% out of normal weighting, then you rebalance. That's fine. And it's important that you have a rules-based rebalancing system. But right, on the whole, trading tends to lead to capital gains. Trading tends to lead to some drag on the portfolio. And over-trading is by far a larger problem than under-trading. Question number 16, how do you report investment performance? And then Zweig says you should report it after all expenses compared to an average of highly similar assets that includes dividends and includes interest income, and you should report it over the short term and the long term. And I totally agree. Investment performance should be shown net of all fees, like what has the investor earned after they've paid their fees. It should be shown compared to a benchmark, and that's what Zweig was saying, an average of highly similar assets. Performance should include dividends and interest income, absolutely. And so should the benchmarks. And that's a really, as you'll hear with Don McDonald later, one of the oldest tricks in certain advisors' books is to compare their product's performance. And they'll compare it to, say, the Dow Jones or the S&P 500, but they won't include dividends in the returns of the S&P 500. And that's such a fundamentally flawed thing to do. It's so sneaky and bad to do. So anyway, benchmarks should always include dividends and interest income. And then yes, the timelines of investment performance should be shown. Yeah, you can show quarterly and year-to-date performance, but you should also show 3, 5, and 10-year performance and longer time periods too. Question 17, which professional credentials do you have and what are their requirements? Then Zweig says, among the best are the CFA, Chartered Financial Analyst, the CPA, Certified Public Accountant, and CFP, Certified Financial Planner, which all require rigorous study, continuing education, and adherence to high ethical standards. Many other financial certifications are marketing tools masquerading as fancy diplomas on an advisor's wall. I agree with this. Here, our firm, Cobblestone, we have 7 certified financial planners. And I should say, I think we have 42 employees now. 7 certified financial planners, 6 chartered financial analysts, 2 CPA accountants. We have an attorney, trust and estates. He started in trust and estates, like I said earlier. He doesn't write legal documents anymore, but he's a T&E attorney and taxation attorney. And then I think we actually have 4 younger employees right now, all simultaneously studying for their CFPs, which is just awesome. They're kind of taking the initiative there. But yeah, going back to the earlier question about what do you focus on? Is it solely investment management or is it comprehensive wealth management, and why? I mean, one of the thoughts that we have is, there's a reason we're able to provide this comprehensive wealth management. And in large part, it's because of the expertise we have on staff. I think, just doing some math in my head, that's what, 17 credentialed professionals, I think, out of 42 employees, with 4 more waiting in the wings. And it's important that we provide that kind of expertise to the people that we work with. Question number 18, after inflation, taxes, and fees, what is a reasonable estimated return on my portfolio over the long term? Then Zweig says, if I told you anything over 3 to 4% annually, I'd be either naive or deceptive. And I agree with what Zweig is saying here. And the math explains pretty clearly why that is. So let's start with a typical 60-40 portfolio. If we look at historical track records, that portfolio over a long period of time might return something in the 8 to 9% per year range. First, we have to take out whatever fees an advisor is charging you. So maybe that 8 to 9% drops down to, let's say, 7 to 8% per year. Then we have to take out taxes. Again, depending on the actual proceeds there, if you earned 9% in your portfolio, odds are the tax bill is going to be between 1 and 2% of that. So we were at 7 to 8. Now we're probably going to drop to something like 5.5 to 6.5, something like that. And now we have to think about inflation. And if inflation is 2 to 3%, well, let's just use 2.5% there as the inflation number. Our 5.5 to 6.5 drops down to 3 to 4%. So again, that's after inflation, after taxes, after fees. The real after-tax return that an investor will get is something to 3 to 4% annually. That's still growth, right? Real growth is real growth. And that's what we want. We want to have post-inflation real growth in our portfolio. But for someone to sit there and say your portfolio is going to grow at 10% per year, right, that's not exactly the truth. There's a little bit of obfuscation there. Granted, the way the question is worded is after inflation, after taxes, after fees. And that is the way to ask this question if you're out there speaking to an advisor. The gross return of your portfolio is nice to understand, but really the number that you care about as an investor or you care about as a client is after inflation, after taxes, after fees. And that brings us to question 19. Who manages your money, Mr. or Mrs. Advisor? And the answer that Zweig proposes is that I do. And I invest in the same assets as I recommend to my clients. And again, I love this question. And this question actually was part of the reason why when I started working here, I was like, you know what? This is a really important question. And I wanted to dive deep on the way that we invested our assets anyway. And so, right, my investable accounts, my old 401k, I rolled it over into an IRA and it's managed here in the same exact way, in the same exact individual securities, right? The same strategy, the same securities as what my clients hold. So when I'm working with, say, a much older client, maybe they're in a much more conservative 50-50 portfolio. I'm in a more aggressive 80-20 portfolio. So the fractions are different, right? The percentages are different, but the actual ticker symbols, the actual assets that we own are one and the same. I invest in the same assets that I recommend to my clients. And I think there's some real power in that. And there's some truth in that. And if someone doesn't necessarily do it that way, it's worth understanding why. It definitely is worth understanding why. So that's Jason Zweig's 19 questions. And I think they're 19 great questions. And as I said, if you want a copy of this, I'm absolutely happy to send you the PDF version that I have. I did mention earlier that there are a couple more questions that I just think they're very simple, very straightforward, and I think worth adding to this list. The first one is to ask the advisor, what's your succession plan? I think it's important for any advisor out there to ask themselves, well, if I got hit by a bus, what would happen to my clients? Or there comes a certain age when it's simply, hey, if you're looking to work with an advisor who's 55, they probably have a wealth of experience. But if you're 55 yourself, let's say, let's face facts, your advisor might be retiring in 10 years and you're still going to have 20 years of life after that point. So you might have to go find a new advisor, or maybe they have an internal succession plan. And I just think it's worth understanding that your timeline as a client might not match up with your advisor's timeline in their career. And it's just worth having that conversation up front. The second question I would add is, what is the communication cadence that you should expect as a client of a particular advisor? Different folks have different expectations there, right? If someone comes to me and they say, you know what, Jesse, I really want to have a weekly roundup call every Friday afternoon to hear how my portfolio is doing, I'll tell them up front, like, hey, that's not really how I do things. That's too much. It's too much time. And that's not how I approach my client service. It's also not how I think you should approach the investing problem, as it were, to have a weekly check-in. If instead someone said, you know what, Jesse, I'm hiring you, and to be honest with you, I don't really want to hear from you. I just, I'll let you know when I'm ready to talk, and it might not be for 5 years. I also don't think that's very good. I think it's important part of the financial planning process is to have some regular check-ins. But anyway, I do think it's important for you as a client to have a pretty similar expectation for communication cadence as what your advisor, how they tend to operate. So you should figure that out up front. The third question I think you should ask is how many clients or how many households or how many families does your advisor work with, or does the firm work with? And perhaps you can add to that too what they believe an appropriate amount is. Because again, some advisors out there will say, I work with 50 families. And the reason why is because it's just me. I'm a solo advisor. And it takes a lot of work to work with a family. And I don't have any support here. And so 50 is the right number. That's where I limit myself as. There are some other advisors. I won't name names or name firms, but there are some people I know who, in their words, they would have over 1,000 clients. Now, the reason why that tends to be is because their clients are someone who they sold a product to and then haven't really kept in touch with ever until that product expires and it's time to renew a new product. But think about it. If you had 1,000 clients, there's only 2,000 working hours in the year. So something there doesn't quite add up. Depending on who you ask or depending on where you look, the quote unquote appropriate number of clients will vary. It probably depends on the service that an advisor plans on giving to their clients too. I've seen numbers anywhere from, say, 75 families up to 200 families being like these reasonable numbers. I could see arguments for different numbers in there too. But either way, I do think to myself that somewhere in that range, again, depending, I think if someone says they support more than that, hopefully it's because they have a lot of backup, a lot of people behind them. I know here, we have, like I said, 42 employees and we serve about 1,000 families. And the reason why, I've talked about it before, we split up responsibilities here amongst a few different teams. We have a relationship management team that I'm on, a financial planning team where all our CFPs and our attorneys sit, investing team where the CFAs sit. And so the idea is that it allows us to spread some of the planning or portfolio management workload into subject matter experts. But still, right now I'm working with like 60 families. That number definitely has a lot of room to grow. But still, I can see the limits coming, right? And I can see some of my colleagues who maybe are working with 120 or 140 families, and they're just doing the relationship management work. They're just doing the client service, the client-facing work, and it gets really, really busy at those numbers. So it's worth understanding that before you start working with an advisor. And then the last question I have is, can I speak with a client or two to hear their opinion? I think that's a totally fair question to ask. Is anytime you're looking to reach out to an advisor, it just is a really hard decision to make, I think, when maybe you've never worked with an advisor before, or maybe you're just having a really hard time delineating between how different advisory firms work or how different advisors work, or the difference between an insurance agent, a broker-dealer, a fiduciary advisor. It can be hard to tell the difference. So asking them, hey, can you put me in touch with a client to hear their opinion, I think is a worthy question. Just know, and they're probably only going to put you in touch with a client who they know will give them a positive review. I can certainly say that when I've been asked that question, I think of my clients who are most likely to be, enthusiastic and optimistic and just say like, oh yeah, sure, Jesse, I'll talk to one of your prospective clients, no problem. Well, yeah, those are probably also clients who will say good things about me. I think most of my clients will say good things about me, but just know it's a good question to ask, but just keep it with a grain of salt, right? In terms of when you hear what the client has to say. That's all. Here's a quick ad, and then we'll get back to the show. I love getting your questions, and some of you ask me questions about the wealth management firm I work for in Rochester, New York. Others ask about the Best Interest blog and this podcast, Personal Finance for Long-Term Investors, which operate without advertising, without pushy sales, and with no paywalls. How can the blog and podcast stay afloat without me dumping my own money into it? Well, to answer both those questions, I want to point you to episode 78 of Personal Finance for Long-Term Investors. I intentionally recorded episode 78 to shine light on those topics and inform you how you are actually helping and can continue helping these projects carry forward. So if you've ever been curious about the business of my blog and podcast, or if you're curious about my day job in wealth management, please check out episode 78 and let me know what you think. And with that, I now want to bring Don McDonald into the episode. Like I said earlier, Don is a longtime financial radio host, author, and educator known for his no-nonsense approach to investing and personal finance. As the co-host of Talking Real Money, Don helps listeners navigate the complexities of markets, emphasizing evidence-based investing and avoiding high-cost financial products. With decades of experience, Don is a strong advocate for fiduciary advice and simplifying money management for everyday investors. Don, thank you for joining us today. And for those unfamiliar, I think it's important we set a little foundation today and we define this broad category of investment products that we're going to spend the rest of the conversation talking about annuities. And then, a broad definition.
Sorry. I'm sorry. I'm allergic to the term. It causes my eyes to water, my nose to run.
Because to me, and no pun intended, or maybe there's a pun intended, it's like the word snake. Are we talking about a 1-foot garden snake that kind of helps out and eats some bugs? Or is it a 15-foot anaconda?
Both kinds of snakes scare my wife to death. We just had a rat snake in a black racer in our yard in Florida. And I mean, she's freaking out. I said, honey, it's fine. She goes, but look, it's shaking its tail. I said, that's because it wants to scare you, but it's not poisonous. Most annuities they're not life-threatening, but they are wealth-threatening.
Wealth-threatening. So just really broadly, when someone hears the term annuity, what should they be thinking from not whether good or bad? I mean, we'll get to that part, but just what exactly logistically is an annuity?
Oh, darn it. I was going to say sales pitch. If you want, what should you be thinking? Sales pitch. There's a saying in the financial business that annuities are not bought, they are sold. No, I have never met anybody going, I think I need to buy an annuity. But let's define the different types of annuities.
Great.
Because there is a universe of them. And I'm going to cover the broad, not the granular, because the insurance industry is massively creative when it comes to developing variations on the product theme. But the primary annuity, the one that most people think about when they think of annuities, is the fixed annuity, which is an annuity that is a contract with an insurance company. You give them a chunk of money. They say, we're going to give you an interest rate of this over X amount of time. That's how it works. You give them the money. They take the money and invest it in ways that can make more money because of their economics of scale. And they give you a portion of that and they take a profit out of the middle. And a person selling that annuity to you, 99.99999% of the time is going to collect a pretty sizable commission for selling that to you. Now, that is a non-disclosable commission because of the lack of regulation over the insurance industry. It is pathetic regulation. So that's type number one. Type number two, which is very popular with seniors, basically it's what a pension is. It's an income annuity. And a pension is basically your company goes out and buys or puts up the money to pay all of its retirees a set amount of money every month for the rest of their life. It's called an immediate annuity, which means it immediately starts paying you income. Here's the downside. You're looking at the number going, well, wait, that's great. That's 7% per year. That's more than I can get on a CD. Well, wait, there's a catch. You gave them all your money. You can never get it back.
But what if I die tomorrow, Don? You're saying I can't.
Sorry, SOL. You're out of luck. The money is the insurance companies. Unless you got a rider, which was a joint life or some sort of certain term over which that annuity will be paid to your beneficiaries, you're out of luck. That's the gamble. And guess who wins this gamble?
Not me.
No, the insurance companies, they have to. It's like a casino. If more of the players won than the house won, well, that casino is going to go belly up, like those of a major real estate developer many years ago, whose name I will not mention.
So let's dive into really quick, while we're still defining this down, let's dive into, so there's this bad reputation, some of the specific fees or commissions, timelines and contracts. You said it's non-disclosable, but still, I know you know some of what's going on under the hood.
Yeah. Let me just grab the last two big categories. The next one is a variable annuity. Now, you're going to find this in almost every 403B plan or 457 plan in America because the insurance companies have swooped in and really captured this market. And a variable annuity is an annuity wrapper, which is, by law, it gives you tax deferral around a portfolio of mutual funds. So you pick the funds within the annuity. The reason why it makes no sense for a 403B or a 457 is the fact that you can't get tax deferral twice. You only get it once. And the 403B and 457s and IRAs and all those are already tax advantage. What it does is it inserts another level of layers that decrease your return. And then finally, the industry's latest horrible lie is the indexed annuity or the equity indexed annuity or variations on that theme. There are also some indexed life. And these are products where they tell you can get the return of the stock market with none of the risk, which in itself is a blatant lie, and you'll never see that written down. They'll say stock market-like returns with none of the risk, but they'll speak the words in their steak dinners telling you that this is the greatest thing. So let's talk about commissions.
Yeah, let's talk about them.
Commissions on very vanilla, cheap annuities can be 1 or 2% at the lowest end. They can be very, very low. At the highest end, I've seen them as high as 12% on indexed annuities. Your spread's going to be somewhere in there, but the problem is they're not going to tell you. If you go to one of these free steak dinners, and this is where indexed annuities are pitched all the time, why would they pay for a Ruth's Chris filet mignon, put it on your plate, if they were doing what was right for you? Why would they do that? I just love you people. I just want to give you a steak. No, they're doing it because their commission's probably 8 or 10% on this thing. And if they can just get a couple of you to buy it, you've paid for the dinner and the Lexus.
So on if I'm a retiree and I'm thinking about taking my $300,000 that I've saved in a 401k, rolling it over to an IRA, and then buying one of these annuities because a steak dinner salesperson told me so. An 8% commission there is what, $24,000 on 300? That's the salesperson's incentive to push.
You got it. You have it. And it's so funny because I run into a lot of these. And in fact, many of them have radio shows. For some reason, these guys have a lot of radio shows. The reason being, again, the profit margins. The margins are great. And they say they're a fiduciary. We're acting in your best interest. And some of them are CFPs. How the Certified Financial Planner Board lets them get away with this is baffling. I've reported some of them to the CFP board, never received a response from them. Never, ever, because they're protecting their own. But these guys will say they're a fiduciary, and then they'll sell you an indexed annuity.
I have a story about this, Don. There's someone I know in person here who dropped that line on me. I mean, he was trying to pitch me on why I was going about my career the wrong way.
Wait, you're an investment advisor rep, right? You're an IAR.
Correct.
And he tried to sell you?
So he tried to pitch me that I wasn't going about my business the right way. And he said, well, Jesse, you have 7 CFPs on staff and you guys don't sell annuities? Like I was a crazy person. And I said, you're a CFP who's supposed to be acting as a fiduciary and you do? Now here's something I learned. The CFP, to obtain the CFP, you have to take an ethical oath to act as a fiduciary.
Yes.
You do not have to take a legal oath.
I know. It's an ethical. It is not a legal oath. The only legal one is the SEC's requirements.
Correct. And that's where you and I know, like my firm, right? And we were talking offline, the work that you've been doing. We have to take a legal obligation to act as a fiduciary. And if we don't work in a client's best interest, sue us. That's something that these annuity pushers that you were just talking about, they don't face that threat. When legal suit comes, that will change your behavior to make sure that you really are acting in the best interest of clients.
Problem is, though, the lobby for the insurance industry and, by the way, for the broker-dealer industry is so strong, so powerful, so well-funded that, as a matter of, I'll give a story. Several years ago, back around the time when I started talking real money, like 15 or 16 years ago, I don't remember the exact time frame, indexed annuities were just coming into their own, and the Securities and Exchange Commission had proposed regulating them as a security because they sell them as if they're the stock market, right? You're going to get the return of the stock market with none of the risk. So the SEC said, we really need to regulate these as investments, not as insurance policies. Well, my understanding is that the insurance industry spent a couple $100 million lobbying Congress to keep the control of the regulation of those products under the states, not under the federal government, which allowed them, because have you ever looked at the makeup? Now you're in New York, right?
Correct. Yep.
You actually have a pretty strong state insurance commission.
Correct.
Some states, though, if you look, you'll see that they're either former insurance company executives, or if you look forward down the road, you find that many come from leave the commission, retire, and go to work for a big insurance company. Wonder who they want to help.
So that's a really good little side point right there. The annuity industry doesn't have much federal oversight. Instead, there's a state-by-state insurance oversight. Correct.
In essence, there is no federal oversight of the insurance. The only reason there's some federal oversight of variable annuities is because of the fact they have a security within them, or securities within them, in the form of mutual funds.
Here's a quick ad, and then we'll get back to the show. Every week, I send a quick free email to thousands of readers that shares 3 simple things. 1, my new articles and podcasts. 2, the best financial content of the week from all over the internet. And 3, a financial chart that explains some important concept in the news that week. It's a great primer to boost your financial know-how.
But Jesse, I don't want another email.
Well, this might not be for you, but I do hear you, which is why I make it very short, sweet, and full of only the essentials. A whopping 66% of subscribers read my email at least once a month. They're enjoying it, and maybe you will too. You can subscribe for free on the homepage at bestinterest.blog. Again, that's a free, no strings attached subscription at bestinterest.blog. So real quick, we already kind of got into some of the conversation about who the people are who are selling annuities, Don. And I think one of my challenges, I just had a conversation a couple of weeks ago with a woman here at work. Her current advisor, she dearly enjoys spending time with her current advisor and the company and the conversations they have. And she sees her advisor as a very good person. Her advisor also has put this woman in $1.5 million worth of annuities. And to me, I think to myself, there are a lot of really good people in this world who maybe I don't agree with exactly what they do for work. And so from your point of view, I mean, you've been to the steak dinners, right?
Oh, yeah. I love going to the steak dinners. My wife won't let me go anymore because she has to go. You have to take your spouse. And I embarrass her, and I make them mad. I have ruined many a steak dinner and felt very good about it because, and I told her this, where she said, "Oh, look at this one. This is a Ruth's Chris. Let's go." In fact, it was yesterday. And I went, "Okay." She goes, "No, you can't say anything." I said, "I can't not say anything." I said, because I'm sitting in a room with a bunch of very nice people, albeit chintzy, and they're looking for cheap dinners. But I'm sitting in a room with a bunch of nice people, and can I, with a clear conscience, allow this incompetent nincompoop up at the front of the room to sell them such a horrible, misleading product? Can I do that? Oh, by the way, it's not just me who thinks this about indexed annuities. FINRA has an investor alert about them that they've had up for years, about the understandings that are promulgated by the industry. They want you to misunderstand them.
Yeah.
And by the way, if you're ever sold one of these, ask for the disclosure document. When you get it, you'll realize just by holding it in your hand why this is not a good investment, because it's so big.
Because you can't carry it.
You won't read it.
But help for the listeners, Don. I mean, help them understand from your experience. I mean, I'm genuinely curious. Are the individual people, the humans who are doing the selling, are these just people who have just terrible misaligned incentives? Are a good person? Are they in a bad spot? Is it just deliberate ignorance, unknowing? They're genuinely convinced they're doing the right thing? Or do they just deep down inside, they know they're screwing you and they're okay with screwing you? Because
I think the answer is it runs the gamut of humanity, from outright crooks. And those are the ones who have the radio shows that they pay for in major markets and come right out and lie on the radio. They know what they're doing, particularly those that are CFPs. They've decided that they're going to get a lot more butter on their bread with an indexed annuity than by a fee-based or fee-only financial planning practice. So those are the worst of the worst. Okay, I went to one just down the street from my house. The guys were middle-aged. You could tell by the way they spoke that they weren't the brightest bulbs in the box. And one guy was actually wearing a cheap polyester suit. And I mean, it was the cheap polyester. It was almost a dressy pantsuit, a tracksuit. It was just so bad. One guy had his shirt unbuttoned all the way down with gold chains.
great.
It's like mobster. You're thinking, mobster? This guy's a mobster. And this was one of them where I asked questions. They put a chart up in front of the room on an easel. It's a cardboard, done at Kinko's chart.
Mm-hmm.
And it shows the stock market since like 1929. And this stock market, they show you the stock market since 1929. I think they used the Dow or something. Maybe it was the S&P. No, because the S&P didn't exist back then. anyway, they show you this horrible chart and tell you how over decades, if you invested in the stock market in 1929, you didn't make any money. Well, I pull out my phone, I look at the numbers, I go, wait, excuse me, did you include dividends in that? Oh, dividends? Well, I don't know. I said, I don't think that includes dividends. I said, I'm pretty sure if you include dividends, you made money after about 5 years. I said, no, I've got, anyway, so he shut me up. Oh, well, let's move on. And then at the end, I said, so what's the cost of this? There's no cost. I said, there's no cost? Well, how do you make money? The insurance company pays me. I said, so the insurance company pays you and they don't take what they pay you out of the money you raise? No. I said, so that is now a lie.
Right.
Because every penny they pay you has to come out of the money they take from clients. So it's a lie. The business is based on lies, lie after lie after lie after lie. But the thing is they're spoken lies. So you can't really nail them on it as long as they gave you even a link to that ponderous multi-hundred-page disclosure document.
Right. The truth is in writing, and the truth is in writing in this really hard to untangle document. But the idea is that the document that you end up signing as an annuity purchaser, technically that document has all the truth in there.
And it says you read the document.
Right.
Well, think about it. When was the last time you downloaded software and read the end user agreement? Have you ever done it? Ever in your life? I haven't.
No.
Never. Not once. And I'm an advocate for people, but I have to trust that they're not going to shaft me, but you can't do that with insurance salespeople.
I want to start arming our audience right now. Some of them are approaching retirement age. They're on the AARP list, and that means that the steak dinner postcards are starting to show up in the mail, Don. So what are some of the most misleading sales pitches? I mean, you've already talked on some of them. What are some of the sales pitches that we need to arm ourselves against? How do the salespeople take advantage of maybe some of our fears to then sell to us? How do the guarantees get misrepresented? What are the red flags? Take it from here.
Well, there's no greater fear for an investor, particularly a senior investor like I am, than the prospect of losing a substantial amount of what you have now saved 40 years to build. You don't want to lose it. And that's the biggest one I think they exploit. This fear of losing it to a horrible downturn in the market. But if they told the truth, then you wouldn't be as afraid. Because the reality is there aren't a lot of dramatic declines in the market. In fact, there aren't any that were permanent. Never has there been a downturn in the market, even 2008, which was the worst one we ever saw for stocks. And having said that, then what's the solution to avoid that bad feeling? Because if you ask any of your clients, any person on the street, you got $1 million and I take away 500,000 of it, I'm going to just take it right now from you. I'm going to walk down the street. Now, before I go, I promise I'm giving it back. Well, at least I promise I've always given it back in the past. Pretty sure I'm going to do it again. I could get hit by a bus, but if I don't, I'm giving you the money back in a year. I'm giving it back. Are you okay with me taking it away and bringing it back in a year? Or maybe 2. Can't promise anything. Most people will say, oh, no,
right.
You can't have it. Well, then that's where what we do comes into play. And that is creating the right plan for every individual's individual risk profile and risk need. It's a combination. How much risk can you take? How much risk do you need to take? So they're gonna exploit that. They're going to exploit. A lot of people hate paying taxes, so they're going to talk about the tax deferral aspects of annuities. That they're going to give you tax deferral. Well, let's use a variable annuity for example. They're saying, okay, you got all this money in this taxable account. It's not in your IRA. It's not in your 401k. It's in your taxable account. Why do you have that in a taxable account when as that money's making money, you're paying taxes on it? Let's put it in one of these variable annuities where we'll shelter it from taxes. You won't have to pay the taxes till you take it out. But I neglect to mention that if you have it in if part of your portfolio is in equities and you have it in ETFs, you will probably not experience any taxable capital gains until you take the money out. And then when you pay taxes on that, you will pay it at a capital gains rate, which right now is dramatically lower than the income rate. When you take money out of your annuity, you will pay taxes at your income rate. It's a bad thing. And the deferrals is not very valuable. It's really not very valuable. As a matter of fact, it doesn't even exist in a tax-deferred retirement account.
So Betsy is listening right now, and she owns an annuity, maybe even more than one. Because I don't know about you, they tend to come in like bunches.
Yeah.
People will come in with 8 unique annuity statements. So maybe you can explain why that's the case.
Dude, you nailed it with the story of the woman who believes this person is so nice. Because what is the common denominator for successful salespeople?
Likability.
They are so nice. A great car salesman, woman, so nice. Insurance, so nice. Whatever it is they're selling, particularly if it's on commission, man, you got to be nice or you don't live.
Right.
So what the problem is, the reason they're getting sold it is because the person was so nice.
Yeah. To expand on that story a little bit, this woman sat in our office. She's been working with her advisor. I'll call her advisor Sharon. She's been working with Sharon for 20 years. And so I asked the woman sitting across from me with all the annuities, I said, when was the last time Sharon discussed fees with you? And the answer was, I don't think we've ever talked about fees. I mean, that should paint a picture for all the listeners right now. It's been 20 years and they've never once discussed fees.
The fees are so well hidden, they don't have to.
It's a little scary.
I remember, because I'm old, back when I was a broker, back in the days when Dean Witter was sitting in Sears Roebuck and Company stores, and then I got religion and got the heck out of it and got into radio, being told by Dean Witter at the time, they had just, no-load funds were suddenly coming into their own. This was in the mid to late 80s. No-load funds were coming into their own, and it was really starting to hurt our sales of full commission funds. Our commissions generally ran 5.75% on a mutual fund. So I don't know if it was Dean Witter or who came up with it, but it was a brand new idea that they just got approved by the Securities and Exchange Commission. They got 12B1 fees approved so that they could create and roll out what I call, and Christopher Cox of the SEC also called them this, liar load funds or sales loads in drag. They never put any of this in writing, but they would tell us when you call somebody, you don't talk about commission, but if they ask, you can say, oh, no, you don't pay a load on this. There's no commission. There's no commission up front. There's no front commission. You would say it really quietly. And because you knew nobody was going to read the prospectus and see that the commission was coming through this new 12B1 fee at 1% per year for every year they had the fund. And if they got out early, that's okay. There was a surrender fee. So they got paid back the commission they paid to me. So this is what the insurance industry does. They obfuscate the fees. You de-emphasize any of the negatives and you emphasize only the positives. Positives being decent return, no risk, or no taxes.
What's Betsy to do? Betsy owns 8 annuities right now, and she's listening to us, and she all of a sudden feels like she's been dealt a raw deal. What can she do about her situation?
Is Betsy up in or approaching retirement? Probably is, right?
Let's say yes.
Because she's gotten 8 annuities, so she's probably got a fair chunk of change. So we're talking she's got like probably $1 million.
Right, exactly.
If she's heading into retirement or in it, this is when you desperately need true financial planning. And anyone who sells an annuity, in my book, is not a comprehensive financial, 100% fiduciary, always taking care of your best interests advisor, because they can't be. If you sell someone an annuity, you have to know that most of the time, unless a series of very special circumstances apply, that is not a suggestion that's in a client's best interest. The only instance where it might make sense is if somebody must have a set income for the rest of their life. They have to have it. Their peace of mind is so much higher than their need for return. Anyway, having said that, what I would suggest every time is that that you seek out someone like you, someone like the people at my firm, someone like the people at a list. I got a list of them on talkingrealmoney.com of firms that I believe always act as a fiduciary. Not just us, not just you guys. There are a lot of them. Problem is they're hard to find.
Right.
Because 100% fiduciary firms tend not to advertise very much. Because generally speaking, they're doing pretty well. Because they're honest. But You need a planner. If nothing else, you need to get a financial plan, just a financial plan. Now, that's going to cost you several $1,000s. It is not a cheap document because it entails a lot of work with you and your advisor and your planner, and then your planner and their team to create the plan. It is a comprehensive document, but if it's done by a fiduciary, it's going to be in your best interest if it's done by a 100% fiduciary. So at least get a plan. If not, start working with an advisor, because even though you go, oh, what's 1% per year or 75 basis points per year or whatever it is, you just paid 5, 6, 7, 8, 9% for those annuities you got into. And generally, the insurance companies, I guarantee, making more money than you are in aggregate.
And so I think, Don, second question, it might be a very similar answer, but Betsy's brother, Jim, is also listening right now.
Hey, Jim, nice to talk to you.
He loves the idea of guaranteed income, as many of us do. It's understandable, right? Mm-hmm. That appeal, and everybody's retirement, whether it's Social Security, pension, bonds, they have some form of guaranteed or fixed income in there. So he's been thinking about an annuity too. Maybe he's thinking about going to the steak dinner tonight. What does he need to know before he, dumps the A1 sauce on his steak?
Buy the steak. Just go ahead and buy the steak and skip the dinner, because these people are really good at what they do. There's a human thing we have. I don't know what the psychological terminology is, but it's a tendency to reciprocate.
Oh, yeah.
We want to be reciprocal.
Yeah, it's just part of the social fabric of our brain.
You got this free dinner and you feel like, okay, I should take the meeting. Because that's what they're there to get you to do. They're there to get you to take the meeting. Here's what happens. They hold dessert until you give them the meeting. And they've even said that. One of them I went to, they said, well, yeah, we're not gonna give you dessert until you sign up for one of these meetings, because if you sign up for one of these meetings, you're really going to change your life. No. And if if the sales pitch is that dominant in the dinner, imagine what they're going to do to you in their office. Just pay for the steak.
I love it, Don. I love it. So let's talk about where our listeners can start tuning into your show. How long's it been? Give us a quick history. What's it been, Don? 30 years?
I have been doing a financial talk show of some kind. Before podcasts, I was on 90 stations across the country with Business Radio Network. I did a national talk show, which went from network to network to network as radio became pay to play. Radio is now, in the financial end of radio, it's almost entirely pay to play. And then I started doing podcasts with Paul Merriman of Merriman Capital, who's well-known nationwide. I've worked with Paul for many, many years. Paul's the one who taught me all about dimensional funds and Avantis funds and this evidence-based approach to investing, which I just adore. Back in 2009, Tom Cock and I, who's my co-host and partner, Tom and I worked for Merriman Capital, or Merriman, whatever it was called at the time. And funny thing happened. We were both in the marketing department, okay? Funny thing happened. They called it 2008.
Ooh.
What did firms do in 2008 when the market dropped by about half?
Probably cut some staff.
Got rid of marketing. So we got laid off. And so in 2009, we got together and we went, maybe we should start an investment advisory firm based on what we're good at, which is educating people. Base it on education. Don't base it on sales. We don't want to push sales. And so that's what we did. We started a firm called Vestory and the podcast Talking Real Money almost simultaneously. We're still doing it. If your podcast is there, just type in Talking Real Money in the search bar and you'll find us right there. We're not as popular as Stacking Benjamins. Dang joke, Saul CI.
Well, Don McDonald, thank you for stopping by Personal Finance for Long-Term Investors.
My pleasure.
Thanks for tuning in to this episode of Personal Finance for Long-Term Investors. If you have a question for Jesse to answer on a future episode, send him an email over at his blog, The Best Interest. His email address is jesse@bestinterest.blog. Again, that's jesse@bestinterest.blog. Did you enjoy the show? Subscribe, rate, and review the podcast wherever you listen. This helps others find the show and invest in knowledge themselves. And we really appreciate it. We'll catch you on the next episode of Personal Finance for Long-Term Investors. Personal Finance for Long-Term Investors is a personal podcast meant for education and entertainment. It should not be taken as financial advice, and it's not prescriptive of your financial situation.